Welcome back to Talk Tickers. We're here to give you that essential deep dive, cutting through the noise of the financial quarter. Today, we are unpacking the Hub Group third quarter 2025 earnings call that came out October 30th after the close.
Yeah, and this quarter was, well, a real study in contrast, wasn't it? You've got this soft freight environment just pushing against everyone. But then you look at Hub Group and you see really disciplined execution internally. Plus, they made some pretty aggressive strategic moves with acquisitions.
Right. So our mission today is really to filter out that constant chatter about, muted demand and focus on what actually got the stock moving. Because the market did react well. Shares jumped almost 4% the next day. So why?
It's about the path forward, I think. Management laid out a pretty clear strategic path for growth, especially heading into 2026, and the market liked what it heard.
Okay, let's start with the numbers then, just for context. Revenue.
Revenue came in at $934 million. Now, that was a slight beat against what analysts expected, but, given the market, still down 5% compared to last year.
And the adjusted EPS, earnings per share.
That landed right in line with expectations, 49 cents, only down about 3 cents year over year.
So you put those together, hitting earnings expectations mainly through keeping costs tight, plus a little bit of a revenue beat.
Exactly. It signaled to investors that, hey, the operational control is solid, the strategy's holding up even with these market headwinds.
That signal seems crucial. The CEO, Phil Joshang, he acknowledged the softer demand.
He did, but he immediately pivoted the story, focused on sequential improvement in intermodal profitability, and importantly, that strict cost discipline. That's really the theme here. Control what you can control in a tough cycle.
Okay, let's dig into that operational discipline then, because that feels like the real story this quarter. Despite lower revenue, they hit an adjusted operating income margin of 4.4%.
And get this, that 4.4% was actually up 10 basis points year over year.
Wow, in this market.
Yeah, that's resilience. And if you look just at the logistics segment, which includes things like brokerage that can be, volatile, its adjusted operating margin held firm at a pretty impressive 6.1%.
6.1%. Considering how soft the spot market is, that must have really boosted their credibility.
Absolutely.
So how tough is it really to expand margins when your top line is actually shrinking? It must take some serious cost cutting.
Oh, definitely. And you saw it in the numbers. G&A, general and administrative expenses, were down a sharp 9% year over year.
Okay, 9% on G&A. What about transport costs?
Even more significant for the core business, maybe. Yeah. Purchase transportation and warehousing costs, down 8% year over year. And that wasn't just trimming fat. It translated to 180 basis points of improvement as a percent of revenue compared to last year. That's huge.
That's 180 basis points.
Yeah, and they also mentioned cutting corporate headcount, not drivers or warehouse folks, but corporate staff by 5%. They're clearly right-sizing for the long haul.
So the cost side definitely dialed in. What about generating revenue? Let's look at the segments, starting with ITS Intermodal and Dedicated. That was $561 million.
Right. And intermodal volumes, that's the real bright spot there. 6 consecutive quarters now of growth.
6 quarters. That shows customers are sticking with intermodal.
It does. Plus, they managed to boost revenue per load by 2%, helped by a better mix of freight and some targeted surcharges.
But it wasn't all smooth sailing in ITS, right? Dedicated was mentioned as a weaker spot.
Yeah, the dedicated business had some struggles, lost sites, some customer attrition. It's a tough competitive space out there.
Okay, let's switch over to logistics then. $402 million in revenue there. How did brokerage fare?
Brokerage, predictably, struggled with the soft spot market. That's hitting everyone. But Hub Group reacted. They did a restructuring focused on productivity, got a 7% year-over-year improvement there, and shifted focus towards, better quality, higher margin revenue, not just chasing volume.
And there's a tech story underneath this too, isn't there? Managed transportation productivity, up 50%.
50%. Yeah, it sounds like a typo, but it's not. That huge jump is apparently from prior investments in technology and automation really starting to pay off now.
That's a massive efficiency gain.
It is. And don't forget final mile in that segment. They're actively onboarding $150 million in annualized revenue from new contracts.
$150 million pipeline.
It's just, although management did say some of those startups got pushed slightly in Q4 2026. But the underlying business win rate seems really strong.
Okay, this all leads nicely into, the future growth signals, the acquisitions. They closed 2 key deals in Q3.
Exactly. And these are very forward-looking. They define the 2026 strategy, really. First, the Marten Transport Intermodal assets. That move immediately makes them the #2 player in refrigerated intermodal capacity.
Right.
That's adding scale in a specialized higher margin area.
Number 2 in reefer intermodal. And the second deal?
SITH LLC. That's a West Coast final mile provider.
Yeah.
Specialized.
Okay, but let me push back a bit here. We're praising cost cuts, surgical discipline, but acquisitions bring complexity, integration costs. Any risk the Marten deal, for instance, dilutes those margin gains we just talked about.
That's fair. It's always a risk. But the sense from the call was they see the scale benefit outweighing that short-term integration headache.
Yeah.
The big picture goal for both deals is clear. Get deeper with the big shippers and with their rail partners, UP and NS, especially with that potential rail merger looming.
Right, the merger. We'll get to that. But first, the outlook. They kept the full year guidance, but narrowed the range for EPS. $1 is $1.90, and revenue, $3.06, $3.07.
Yeah, narrowing is usually seen as a good sign, shows confidence. But you're right, the midpoint of that guidance does imply Q4 earnings will be sequentially lower than Q3.
Why lowering Q4?
Well, typical seasonality after Thanksgiving plays a part. But crucially, they said they aren't expecting the same level of peak season surcharges they got in Q4 last year. Those were about $4.5 million in Q4 2024, and they're basically saying, don't count on that again this year. Oh, and CapEx stays tight, less than $50 million for the whole year.
Okay. Now, the elephant in the room. The potential UP&S rail merger. Management sounds almost excited about it.
They really do. They see it as a potential game changer for intermodal. If it goes through, they think it could drive a lot more freight from truck to intermodal, especially on shorter routes. Plus, improve transit times by cutting out handoffs and ultimately lower their own costs. They emphasize customer engagement on this is extremely high.
Makes sense. Customers want to know what it means for them. What about the timing for Hub Group, operationally?
So they expect about 86% of their intermodal network to be rebid and effective in the first half of 2026. About half in Q1, the rest in Q2.
Okay, bidding happens fast. But when do the financial benefits, the real efficiencies from the merger itself, actually hit their bottom line?
That's likely further out. Think second half of 2026, maybe even later. Depends on how the regulatory process and the actual integration unfolds. It's really a 26-27 story, not immediate.
Got it. And they gave an example, right? Louisville.
Yeah, they highlighted a new service they launched in Louisville, said it converted some less efficient volume that used to go via Chicago, and it also won them some new customers right away in that shorter haul market, the sort of preview of the strategy.
And they think they can handle more volume like that without spending big.
That was a key point. They estimate they have about 35% incremental capacity available right now, just by using their existing containers better and, destacking some. And then if the merger leads to faster transit times, that could free up maybe another 10% capacity on top of that. So potentially 45% more throughput without huge capital investment. That's leverage.
That leads to the balance sheet. So maintaining margins, eyeing growth, how does that stack up financially?
The balance sheet looks extremely strong. Net debt to EBITDA is way down at 0.4x.
0.4x, what's their target range again?
Their target is 0.75x to 1.25x, so they're well below. And while they mentioned shareholder returns, dividends, buybacks, management was pretty clear they're keeping their powder dry for more M&A, bolt-ons.
And they put a number on it.
They did. Said they're willing to lever up to 2.0x net debt EBITDA for the right deal. That's a huge signal. They've got firepower and aren't afraid to use it.
Wow, 2.0x. Okay. Meanwhile, there are these macro trends helping them too, right? In trucking.
Definitely. Things like stricter rules for non-domicile commercial driver's licenses, the ELD mandate complexities. It's making life harder for smaller trucking outfits, pushing some capacity out. Combine that with really low orders for new Class 8 trucks, and you get this gradual tightening of truck capacity overall.
Which makes intermodal look more attractive.
Exactly. Especially for shippers looking for reliability, for resiliency. They said customers are really engaged in bid season right now, wanting to lock in capacity, secure their supply chains, and that plays right into the strengths of intermodal.
Okay, that brings us nicely to our not financial advices segment, where we take everything we've heard and pitch a, let's say, plausible but slightly audacious idea.
Right. So you take that super strong balance sheet, the 0.4x leverage, the willingness to go up to 2.0x, that's potentially, over $500 million in immediate M&A capacity, depending on the target's profits, of course.
A lot of dry powder. So what's the outrageous but plausible pitch?
Okay, here it is. First half of 2026, Hub Group makes a move. Not a tiny tuck-in, but a decent-sized bolt-on, maybe a regional temperature-controlled trucking company. Or perhaps a specialized warehouse or fulfillment provider, something tech-enabled for that last mile.
Okay, why that kind of target?
The thinking is it hits two birds with one stone. One, it turbocharges the ramp up of that $150 million final mile business they've won. Two, it lets them fully leverage the scale they just bought with Marten Intermodal by integrating more of that refrigerated supply chain.
And the bet is?
The bet is the stock reacts strongly, immediately on the announcement. The market prices in that strategic logic, the scale, the diversification way before the overall freight market even turns positive again. It's rewarding an offensive move made from financial strength.
That's definitely bold, but you can see the logic based on the call. Okay, quick recap then. Hub Group showed solid execution, impressive margin resilience in a tough market.
Yeah, and the path for 2026 seems clear. Leverage that new reefer scale from Marten, get positioned perfectly for the potential rail merger benefits.
So the final provocative thought for you, the listener, to chew on.
Watch that hidden capacity. Management says they have 35%, maybe up to 45% more capacity internally they can unlock just through better utilization and maybe faster transit times. If they can actually drive significant organic volume growth in 2026 using that capacity without needing big capital spending, the operational leverage could be absolutely immense, something to keep an eye on.
Definitely. And as always, please remember, everything we've discussed here on Talk Tickers is our summary and analysis of the earnings call. It is absolutely not investment advice. Thanks for tuning into this deep dive. We'll catch you on the next one.